Hey everyone, welcome back to another episode. So in the previous episode, I did the state of the market on Denver for Q3 2020. So on this one, I'm excited to say that we're actually doing a very similar presentation on the state of the market for Colorado Springs Q3 2020. So give you a quick backstory on here and the reason why we were actually talking about the Springs, and you'll see a lot more content as well with the Springs, is obviously it's a good market to invest in. But a couple months ago, I'm sure many of you saw the email, or I released a podcast about us expanding, and we were looking for a few more agents to expand here, initially in the Denver market. But fortunately, just a phenomenal agent and investor as well from Colorado Springs reached out. And after we got chatting, realized it was just a phenomenal fit for us to partner up on. So that agent and my guest today is Jenny Bayless. Jenny, how's it going?
Great. Thank you so much for having me on, and I'm really excited to join the team.
Yeah, this is gonna be a fun ride. So quick about you, Jenny, and if I butcher it, feel free to correct me on here. But Jenny, you own about 8 rental properties right now, right?
Right.
So she's similar mindset to what we talk about in the podcast, very much long-term investing, buy and hold rentals. She's investing for at least a few years now. Great thing is she's completed a BRRRR property down there in the Springs. She's bought deals through the MLS, through wholesaling, through networking, even has a FSBO in there, and has also got some different financing sources for taking down properties as well. So lots of experience as an investor. And now after you start investing, then you got your license like a year or two later, right?
Right. Yep. And
Great.
then, yep, exactly. So now I'm an agent and hoping to expand and help everyone down there.
Yeah. And so investor turned agent. So, that's always a great skill set in my mindset. And then also her professional job before she became an investor and agent was actually as a CPA. So she got the analytical mindset as well, which is, as you guys know, just great for analyzing deals, looking at data. So it's, like I said, just overall a great fit for us to partner up on. And so we're going to go through the state of the market here for Colorado Springs. And then I think for next 3 or 4 episodes after this, we're going to do a couple deal analyses as well. One on a multifamily, one on a house hack, one on a single family rental. And I think we're going to do a case study on one of your BRRRR properties you took down, right?
Right.
So it'll be 4 episodes after this as well. So we're going to kind of do a mini blitz on Colorado Springs. And then as we get feedback and do this, we're going to be doing more content in the future in the spring. So as you listen to this, listen to what questions you have, what you like, what information you want to know. Because a big part of this, as Jenny and I started working together, she was going to, she started explaining things to me about the Colorado Springs market. Because I know the very high level data, but nothing like I do up here in Denver. And I realized, a few minutes in us talking, I said, you know what, let's just time out on this. Let's go one step forward. Let's take some of the presentations we have, plug in the Colorado Springs data so she can present it to me. I will ask questions, and the questions I ask, I think, is pretty much what the other questions our listeners will have as well. So we're going to dive into it. So what we're going to talk about in the state of the market, we're going to talk about, Jenny, what? Overview of the Colorado Springs market, some market trends, rent trends, how you underwrite properties in there, is it a good time to buy, some opportunities and tips, and just some long-term considerations, right?
Right.
All right. So if you guys, we're going to touch on some numbers, some points on here. Obviously, we're going to talk all the details in the podcast. If you want to see the screenshots or bullet points or data points, click on the show notes, and there will be a link on there to the blog post, and the PowerPoint slides and all the data will be on there as well. All right, Jenny. So like a lot of people, I know Denver really well. I know this Colorado Springs market very little. So where do we start? What's intriguing about the Springs? What's the overall market overview?
So I think that the first thing to touch upon regarding the Colorado Springs market is that it has a really strong economy. And I think a lot of people in Denver might not necessarily know what it has to offer. So I think it would be helpful if we kind of dive in and talk about that. So the first part that I wanted to talk about was the defense industry down there. Very, very strong. There's several bases. They have Peterson, Schriever, Fort Carson. All those bases have really limited on-base housing or none at all. And then they also have Air Force Academy, and it's the current home of Space Force. So just a huge defense industry presence down there. And with that being said, there's a really good opportunity to be able to provide rental housing to military members because a lot of them don't wish to buy when they're only going to be here for a couple of years. So it's a really good tenant base down there. And then the next thing that I wanted to talk about is that not only does it have a strong defense presence, but it also has a strong commercial presence. There's a lot of technology companies moving in down there, similar to how...
Are you guys seeing like a similar flood to what we're seeing up here?
Exactly.
Really? Okay.
Yep. And then,
Is there like a pocket down there, a corridor, or are they just moving it all over?
Usually in the northern part of Colorado Springs is where you're going to see a lot of the technology companies moving in. So that is a good way to diversify the economy right there. And then lastly, I think what everyone probably thinks of when they think of Colorado Springs is the tourism aspect. There's so many beautiful landmarks, Pikes Peak, Garden of the Gods, so many trails. So that brings in a lot of revenue. And it also brings in a lot of people that when they come here, they think, I really want to live here. So it's kind of twofold benefit for that.
Yeah. So I mean, a lot of the same benefits as Denver, it sounds like.
Exactly.
Because I know something we talk about, because you rewind Denver's history, and decades and decades ago it was very much an oil town, cow town, and now it's a very, very well diversified economy. And it seems like Colorado Springs has followed a similar trajectory.
Exactly. Mm-hmm.
Right. All right. So, what do we got on the slide here? Why invest in Colorado Springs? You got some bullet points up here, some pretty impressive rankings.
Yeah, so I think a lot of people are starting to finally take notice of Colorado Springs being an awesome place to live, work, just a great place to be. So it's consistently ranking high on desirable places to live, and even some real estate related rankings such as hottest housing markets, fastest rent growth. So it has a lot of things going for it in terms of both, lifestyle and economics.
Yeah. And I know you guys can't see the PowerPoint slide here, but she's got quite a few bullet points with just these rankings, and a lot of it's very similar to stuff we see for like Denver or Aurora. Just, hey, number 1 here, number 5 here, number 6 here. Just lots of good headline rankings,
Mm-hmm.
I'll say. When did you move to the Springs?
So we actually moved in March of 2020. We used to live up in Parker.
Oh, really?
Yeah.
I did not know that.
Yeah.
Oh, so you just moved down there, but you've been investing in that for a few years.
Correct.
Just
Yep.
because you like the metrics down there better than Denver?
Yep.
Oh,
Mm-hmm.
interesting.
Yep. And my husband works in the Springs, and I
Okay.
was working up in Denver, so...
Oh, so he was commuting down there anyway.
Exactly.
Okay.
Yeah.
Oh, so that's I did not know that.
Yeah.
I thought okay. So give us some, we took a screenshot from one of the Your Castle Trends packets. As you guys see, the Denver Trends packets, they create one as well for Colorado Springs for the market down there. So give us the high-level points on this, Jenny.
Sure. So I think probably the main thing that we wanted to point out for this is that, there's a lot of questions about how is Colorado Springs doing as a market? And in fact, it's doing just as well as Denver. It appreciated 7% between last year and this year, which is astronomical, I think.
Yep.
And personally, we've seen for some of our properties, because we invest in some of the smaller homes, over 10% a year for the past couple of years. So,
and it seems, I've looked at very high-level data for Springs, Pueblo, up north, and it seems like, Denver is kind of like, I'll say, the front of the tennis ball, or the front of the trends, and then the Springs and Pueblo and other markets tend to be like kind of a year or two behind as looking at charts and growth. Is that kind of right?
I think so. I kind of think of it as a different magnitude.
Okay.
I feel like it has the same trends as Denver, it's just on a smaller scale, which makes sense because it's a smaller city right now. So,
do you know what the population is?
Oh, I don't. I know it's the second most populous in Colorado.
Okay.
Over 100K for sure.
Okay.
Yeah.
All right. So what we're looking at now on the slides you put together is just comparing sales prices. We got Pueblo, Denver Metro, and Colorado Springs. So do your best to explain graphs over a podcast because I'm gonna put that hot potato on your lap, Jenny.
Okay. So for those of you that aren't watching the YouTube, really the best way of explaining this is this graph depicts compounded annual rate of growth since the mid-1980s.
And what is CARG?
So it's basically taking the rate of growth, but then taking out things like inflation and all those extraneous factors to give you a more straight-lined answer as to what is the actual rate of growth for these markets.
Great explanation.
Oh, thank you. So basically, what we can see from here is that overall, Denver is showing at 4.7%.
And this is from, 1985 to 2018, 2020, over that 35-year period?
A good chunk of time to really analyze it. And Colorado Springs is at 3.9%, so it's honestly not that different, in my opinion.
And then Pueblo, just out of curiosity, is at 3.7.
Yeah.
And so, as you said, so this is really taken in out, probably mostly appreciation and cash flow from rental properties. Is that what it is, or is it mostly just a price gain? Do you know?
Price, yeah.
Okay. And so this is actually taking out the inflation, though.
Right.
So these are real gains. So you're talking basically about a 4% gain over inflation in prices for Springs, and upper fours for Denver is what we're looking at. Yeah, those are great returns.
Yeah.
Then when you factor in cash flow and debt paid and all the other stuff, they go up from there.
Yeah.
And if you guys want to see these charts, we'll have these charts on the blog post, or if you want the full trends packet, email me or email Jenny. We can email the PDF as well, because there's probably about 40 slides in that or so.
It was pretty lengthy.
Yeah. It's very data centric. So talking about here price appreciation of Denver homes and Denver condos compared to Colorado Springs homes and condos. So we're looking at from 2010 to 2020. And so obviously we'll start with the Denver home side. So Denver homes in 2010, they were like high twos. So that was right after, kind of like the bottom of the market. And now we've just seen a very, like a 45-degree line going up. In 2020, we're at just north of 500,000. So the Springs has a very similar kind of trajectory. Actually started going about a year or two later after Denver, but had gone up, and they started in the low, just above 200,000, and now they're in the high threes. Okay.
Yep.
And for Denver condos, they started around the 150s in 2010. Now they're at the 350 range. And Colorado Springs, we're at just below 150. So it looks like maybe about 20 grand less than Denver was back in 2010. And now Colorado Springs are at around 250. So both have seen very good appreciation. Yeah. And I mean, this isn't on a slide here, but I talked about this a lot of times with my clients on the podcast. Is just, hey, is Denver in a bubble? And I go back to basically it's no. What is the Springs? I mean, I think I know the answer, but I want to ask you, since you know the data better than I do.
In my opinion, I'm not an economist, I'm not a fortune teller, but I honestly don't think so.
Yeah. But I mean, you're doing cash out refis right now and looking to buy more rentals, right?
I have a ton of faith that Colorado Springs will continue to grow in the same rate.
All right, so this is a slide that is actually the same slide, but the Colorado Springs data for what we talked about, or I talked about in the Denver state of the market on the previous episode, where it shows the buyer's market, a balanced market, and seller's market compared to months of inventory for single-family properties. So I think in Denver, we're at 1.1 months of inventory as of the first week of July. And Colorado Springs is the exact same 1.1 months worth of inventory. So looking at the slide here, it basically mirrors a lot of what we see in Denver, where, the last handful of years, again, starting a couple years later than Denver did, but basically now the Springs has been an extreme seller's market. I mean, you've been bounced around between 1 to 2 months of inventory since 2017. So condos even lower inventory, huh?
Yep.
Is there... what's the condo scene like down in the Springs? Because I know we buy a lot of condos up here for as you know, for a lot of cash flow stuff. Do you invest in condos down there, or have you?
I don't have any condos. I only own single family homes.
Okay.
There are not a lot of condos down in the Springs.
Okay.
I will say that.
Interesting.
Yeah.
And is there a bunch of new apartment buildings going down there like we have them in Denver?
They're starting to. So if you drive down especially near downtown Colorado Springs at this point, you'll see a lot of newer, the amenity-filled type apartment buildings going up.
Like the Class A stuff? And that's it, but that's the whole building's being built for just rentals, right?
Exactly. Yeah. Yep, and it's very recent.
Yeah. Do you know what those cap rates are going for?
I have no idea.
Okay. I know the ones in Denver, they're 4-ish cap rates.
Yeah.
So they at least pre-COVID, and this a year or two ago. But I mean, that was Wall Street money.
Yeah.
They borrow for a lot cheaper than we can. So I'm interested in this. So talk to us about the rent trends, because this has been obviously a very hot topic with COVID.
Yeah.
And we've been doing up here in Denver the monthly PM updates. What's going on with rents overall, the rent trends and the COVID rent trends in the Springs?
Okay, so I would say that it's on par with Denver. I was really worried also to see kind of how COVID impacted everything. But they actually just released the Apartment Association's Q2 2020 report, and they mentioned that vacancy rates were only 4.5%.
Oh, wow, it's lower than Denver.
Slower, and with the caveat of that buildings with 0 to 8 units have a vacancy rate of 0%.
Wow.
Yeah. So, just kind of digging into my own personal portfolio, I would almost agree with that.
And you have all single family, detached single families, right?
Detached single family homes. They're in very high demand because people like their own space, especially during COVID times. People really like their own space. So, my tenants, they tend to either renew year after year, or if they are going to turn over, I can get a new tenant in there within a day or two of the previous tenant leaving. So, in essence, our vacancy rate is about 0% also.
And you self-manage your properties, right?
I self-manage. Yeah. I'm really on top of being efficient in that regard, but you can pretty much rely on a low vacancy rate. Probably not 0, but...
Well, I've noticed as people know, I don't self-manage my properties. I've noticed people that self-manage and they're very on top of things like you are. Mm-hmm. They're at like a 0 to 1% vacancy. And people with property management, I think they're, I'm probably more like a little higher than that for sure. But I think it just comes down to you're way on more top of than I would be, and it's your own asset. What about rental rate increases? Because it was interesting what we saw in Denver, because according to property managers, and these are I say the mom and pop property managers, the people that manage their properties for people like us. Hey, cool, we own a few rentals. You're not big institutional investors. We're not doing the big apartment buildings. They're saying, rents are staying, basically hey, they stayed kind of flat for a little bit. Mm-hmm. And then now once things started opening up back in mid-May, they started seeing rents increase some. They're like, hey, we're going to continue to do our 2% bump or whatever it is, $10, $20 bumps, and they're getting those bumps. Mm-hmm. But the Apartment Association data from Denver actually showed for the big buildings, their rents dropped, I think, $30 year over year. What are you seeing from the small stuff and the big stuff in the Springs?
So,
or do you know?
Yeah, so our apartment association down there, they actually did show a 2% rent increase from last quarter.
So quarter 2 19 to quarter 2,
I believe
is it year over year or previous quarter?
Quarter 1 2020 to quarter 2 2020 was the 2%, and then 4% was the data that I found from year over year.
Okay.
So that's
So both are positive.
Yes.
Okay.
Mm-hmm.
And what about your own rentals?
I have been increasing the rents for those that are currently in my units that want to stay. If I feel as though the rents that they're currently paying are market rate, I won't raise it, or it'll just be a nominal couple $1 a month. But when I get a turnover, I will raise it to market rents. And in one case, I was able to raise it $200 from the previous tenant.
Is that because the rents just jumped up that much in the market, or were you just under market rent that much?
Both.
Okay.
I was very under market rent. She was a wonderful tenant. I stayed there for several years. And then, the market dictated a rent increase. And honestly, we probably could have asked for a little bit more based on where it was located. But
so what did your rents go from to on that unit?
$1,180 to $1,400.
Wow. Okay, so you got $220 on that bump.
Yeah,
that's a big jump.
Yeah.
And what about renters not paying rent? I know if you got any of that. I only got that data from actually talking to property managers for how many people were gaming the system. I didn't dig through the apartment association data for that yet, but do you have a feel for that down the Springs?
So I found a article online out of the Gazette, which is a news source down the Springs, and they said that only 5% of renters were delinquent, and they made no mention of those that were delinquent who actually has not fully not paid.
Yeah.
For our personal portfolio, we've had 100% collection.
Nice.
Mm-hmm.
Now, in your portfolio, do you have any Section 8 renters or military renters?
Yes and yes.
Okay.
Yes. Mm-hmm. So that probably helps a lot.
Yeah.
But
Well, I'm curious, like
yeah.
how many, like what out of the, I think you said 8 properties. Out of that, how many are Section 8 renters? If you don't mind me
Only
asking?
one.
Okay.
So we actually bought the house, and her and her family were living in it, and they're great tenants, and we've been with them for 3 years now.
And the Section 8 down there paying pretty much market rent? 'Cause that's one of the nice things up here is they're getting market rent, all day long in Aurora and Denver.
Yes,
So you're getting market
market
rent
rent. So there's no reason not to go with it.
Yeah.
Yeah, it's been wonderful for everyone.
Nice. I know the government direct deposits every month, huh? So mortgage rates, I know this is basically the same slide we had in my presentation a few days ago, but I mean, let's talk about something, if we can, your personal stuff. I know you're doing a handful of cash out refis. Do you mind kind of sharing what you've seen down there as far as like the interest rate in your cash out refi and just kind of like the spread? Hey, I bought it here for this amount, and now 2, 3, 4 years later, I'm cashing out this much.
Sure,
Can
no
you give
problem.
some context on there?
Absolutely. So the first property that we're doing a cash out refinance, we bought in 2016. And I believe our interest rate right now is 4.875. We had, I think the loan is right about 130 for that. It appraised for 240.
Okay.
And we're able to get 75% LTV at a 3.75%.
And these are like 30-year conventional
30-year fixed, yes.
Okay.
Then our second property we bought in late 2017 for I believe it was 160, and it appraised for 245. Same rate structure for both. And then the last one we just got appraised. We just got our appraisal back at 230. We bought it for 114.
Wow.
Yeah.
Was that like did you big value add or just?
We did. We did a big value add, but we actually did it while the tenant was living in there. She was really amenable to it, so it worked out really well. There's been no vacancy, been able to fully rehab the entire property.
Wow.
Yeah, including flooring and paint even.
Yeah, we'll give her a nice Amazon gift card.
Yes,
for
exactly.
that.
Yep.
And so again, same thing we talked about. I harped on the last presentation. Is interest rates are interest rates. They're going to be about the same in the Springs versus Denver. So just very low right now. So good to buy and good to refi.
Exactly.
Yeah. So this is a question that I get asked, and I put into my presentation in the other episode. But hey, is it a good time to buy rentals in the Springs?
Short answer is yes. The caveated answer is it depends on your personal situation.
I know that answer.
Yeah. So just kind of what Chris mentioned in his state of the market for Denver, I think it's really important to kind of really be objective on your own personal financial situation. Like he already mentioned, do you have job stability? If not, maybe now is not a great time. Wait for things to get a little bit more stable personally. Do you have cash reserves? I'm a huge proponent of having cash reserves. I know, Chris, you mentioned that you're increasing your reserves to 9 months.
Yep.
After reading that, I think I might do a similar analysis, but we operate like very strictly on a 6-month per property worth of reserves, also 6 months personal expenses in a separate account.
Yeah.
And then even with everything going on, we actually opened up a couple of HELOCs just in case.
So let me ask you this question. So let's just say, something bad happens on the property, whatever. Just you get the unfortunate curveball in life or market or business. Would you dip below 6 months worth of PITI, or would you dip into your line of credit first?
Oh, that's a good question. Thankfully, we haven't had to actually approach
that.
I
know the what if.
Yeah, I would go into the 6-month PITI and then work really hard to put it back as quickly
I think
as possible.
I would actually dip in the line of credit first.
Yeah?
Yeah, because I know what you're doing, like the 2008 meltdown stuff, but I got caught in that where I got short on cash in my business back then, and like when I have cash in the bank, I sleep really well at night.
Yeah.
And I've learned, hey, I saw a lot of people. Fortunately, it happened to me. We got some credit cards shut off for our business, which no big deal. It was a pain in the butt, but nothing major. But I saw a lot of people, their line of credits vanished overnight. And that just it stuck with me today, and it just scared me.
That's really smart. Yeah.
Well, you live and you learn. You take
Yeah.
the black eye. So I'm always curious because I see them. Like I like that because when COVID first hit and March became a reality out here in the States, I went back. All right, let me just sit down and spend 2 hours on a Friday night and just look through all my financials. Like, cool, everything's got 6-7 months worth of money in there. And I was like, man, but if I knew mentally if I drop below 6 months, my mind shifts from like feeling good to being on the offensive to going like in a very bad defensive mindset. And that 6 months for me is like a trigger. Like if I dip into it, I go into like hunker down mode. And so I'm always curious what other people thought. So
Yeah. Thankfully, we haven't dealt with that. But I mean, yeah, it's been an interesting mental exercise for sure. Yeah.
All right. So obviously, like your situation, I'm assuming the same thing. Hey, guys, hold on the property for 5, 6, 7 years. It's really, really hard to lose money. Same thing, holds true across any market.
Mm-hmm.
And seeing the data from the spring, same thing. Are you seeing any red flags for a price drop or a wave of foreclosures in 6 months? Anything like that?
I personally, I'm not seeing that.
Okay.
Just because, it goes back to simple supply and demand.
Yeah.
Just not enough supply, and there's so much demand that I think things will kind of stay status quo or increase.
Yeah.
Mm-hmm.
And you're actively out there hunting for a property, right?
I am. Yeah. I'm looking for a fourplex. So
why a fourplex?
If anyone out there has one, basically we're looking for just to be able to maximize our ability to buy using a residential investment loan, which is for property.
So do a 30-year fix on that?
Yes.
Yeah.
Mm-hmm.
And we'll go into a fourplex deal analysis in 1 or 2 episodes from now as well.
Mm-hmm.
And of course, we always throw this in there if you guys want to talk your personal situation. I'm happy to talk to you. Jenny's happy to talk to you. We can both talk to you guys as well. Obviously, if you're in Denver, I'll talk with you. Springs, Jenny knows that market or whatever. Reach out to us and we can definitely give you more details and walk you through what it is. Because I was trying to remember, for all, we have a lot of clients, talk to a lot of people. I'd say somewhere between that 8 to 9 out of 10 people I talk with, it's like, cool, it makes sense for them to move forward and buy. And there's like 1 or 2 out of 10 like, hey, we'd be a little tight on cash reserves, or we're in an industry we're not quite sure what the ripple effect will be. And then they're hanging tight. But I'm seeing right around 8 out of 10 people that's like, great, still makes sense to buy in the long term.
Mm-hmm.
So if you guys have questions, reach out to us. So, here's one of my questions I have a love-hate relationship with. So I'm going to ask you, Jenny. I get people ask me, and this comes from Bigger Pockets, the 1% rule. Are there 1% rule properties in the Springs?
Yes.
Really?
Yes. Sometimes.
Really? Oh, sometimes. Okay.
So my observation on this is probably a couple years ago, we were able to achieve the 1% rule. Now,
explain the 1% rule real fast. Sorry.
So the 1% rule, simple rule of thumb would be $1,000 a month in rent for a $100,000 property.
Yep.
So you used to be able to find that. Nowadays, every once in a great while, you'll see something that's pretty close to it. But it gets scooped up. It's few and far between. But that doesn't necessarily, I don't think that should dissuade people from still pursuing it.
Now, do you actually use a 1% rule in your own deal analysis or underwriting?
I do not anymore.
Okay.
Because just kind of faced with the reality of the situation that is just not going to happen. Yeah.
Now, the other thing I talked about in my presentation was the 50% rule. Again, I think this comes from Bigger Pockets. The 50% rule states that 50% of your income will go towards your operating expenses, and that's basically all your non-mortgage expenses, your insurance, your taxes, property management, repairs and maintenance, yard work, all that stuff. So since Colorado Springs is a lower rent market compared to Denver,
mm-hmm.
Are you at a 50% OpEx ratio, or what ratio are you seeing down there?
I actually personally use 33%. So
really?
1/3.
So you're doing the same thing up here we're doing?
Exactly, yeah.
Okay.
So what we do is when we collect, so all of our properties don't have escrowed mortgages, so we'll take the rent minus the principal and interest payment, put it into a pot, take 1/3 of that, and move it into basically our operating account to pay for when things pop up like that, or
Ooh, here's a question that popped in my mind. If you hired a property manager, would that still cover? Would that be covered under like the 33% rule? Do you
No,
think?
I'd have to increase it.
Okay,
Yep.
so it would go up a little bit more for PM. Okay.
Yep.
So you're actually seeing that. So you said a really good nugget there, where I guess some of your loans are, they're not escrowing your taxes and insurance. And so, for usually conventional 30-year loans, that's automatically part of your monthly payment. But you got loans, I'm assuming, through like a portfolio lender that don't.
Correct.
And so you're paying that yourself, twice a year to taxes, once a year to insurance. And so you're really seeing about a third of your rents cover all that stuff, repairs, maintenance, and everything?
Yes.
That's cool. Now, when we are underwriting properties here in Denver, we do it conservatively and realistically. And I know I've seen the stuff you've done, and you do the same thing with your numbers that we'll go through. And probably not this presentation, but the future deal analyses, right?
Right.
Yeah. So this is the chart I had up in my presentation yesterday, where ran through some high-level numbers like, hey, we run vacancy at 5%. Even though we're realistically a little bit lower, we do 5%. What do you use down there?
I actually use 3% for my personal portfolio.
Yeah.
If I were to use property management, I would probably increase it a little bit.
Yeah. And then, the range I see people do is 3 to 5%. Depends how you want to write it. I like to be, I think the long-term median will probably be 5%. What do PMs charge down there, or do you even know?
I believe it's about the same as Denver.
And you use the same, repairs and maintenance, 8 to 10% for detached properties?
I do.
Okay.
I use 8%, and that was basically, I based it off of running it against my own portfolio. I collected all the repairs, maintenance, cleaning, that type of expense, and it came to about 80% of my gross rents, 8% of my gross rents.
Good to know.
Yep.
And is insurance, I don't know if you noticed, but is insurance about the same down there as is up here?
It's a little bit lower.
Okay. So I imagine, it must be taxes, insurance are lower down there, essentially lower property values,
Correct.
which helps with the lower operating
Exactly.
expenses. Okay.
Yeah. But I have noticed insurance is starting to creep up pretty quickly each year, at least $50 to $100 a year more, including shopping it around.
Really?
Yeah. And I don't know anything about insurance prices or anything, but I have to imagine it has something to do with a lot of the hail damage that we've been seeing down there. So I don't know.
You guys, again, from the weather or the headlines I read, it seems like Colorado Springs gets more hail than we do up here.
Yeah.
Is that
Yes.
accurate headline reading?
Very accurate, yeah.
Because I've talked to some insurance agents up here in Denver, and they said, insurance rates are going because of all the hail damage.
Yeah.
And that's just a matter of life.
Yeah.
Or, a fact of life, I guess. All right, so as we kind of wrap up this presentation, let's talk about some opportunities and tips here. Like, just walk us through opportunities you see and just some general tips.
Okay, so I think that one of the things that I would recommend to investors or those that are looking to invest is to take advantage of the opportunity to stabilize your rental portfolio. So one of those things is to refinance your rental properties, or even your primary, not necessarily even taking cash out, just take advantage of the low interest rates that we're seeing in this environment. I think that's one opportunity to lower costs pretty easily.
If I can interject here, do you know what your interest rate would have been if you just did like a terms-only refinance on a cash out?
It was actually, we were planning on just doing a rate and term refinance until we saw that the lender would give us 75% LTV, and we saw how higher the appraisals were, and the wheels started turning about the return on equity.
Appraisal, you decided to you shift to cash out refi?
Yep.
So what was the original, do you know what the original interest rate quote was for the terms only? Because you're at 3.75 for cash out.
It was the same.
Really?
Yeah.
Okay.
Because we thought that it was going to go up after we said, can we do a cash out refinance? And they said, sure, we can give you the same cost, same rate. Okay.
That didn't have like more point buy down with it?
No.
Oh, because a lot of times what I see, if it's a terms only refinance, it's usually a lower one, or you can get the lower one with a cash refi, but you're paying an extra point to buy the rate down.
Yeah, we were really shocked by that. So it kind of seemed like a no-brainer for our goals.
Yeah.
Yeah. So definitely take advantage of the refinance opportunities. I recommend performing upgrades in your property that you know are on the horizon. Maybe you have a furnace that's on the fritz, something like that. I think that by consciously going in and improving those things can kind of help you just grasp what your overall expense is going to be, as opposed to not knowing when it's going to break, and you get a call at midnight $5,000 later that you weren't anticipating. I think can kind of rattle you a little bit more. So that's just kind of my personal recommendation.
Is that your general recommendation, or is that because we're in the COVID crisis right now?
More so because of the COVID crisis, but I think in general, just mentally, it's easier for me to grasp things that I know are coming, opposed to not. I would say, but so
I agree with you there, because if you can go, hey, cool, let's outlay the cash now to buy. If times are good and you still got some cash, outline it or outlay the cash and still keep your 6 months of reserves for like true emergencies.
Yeah, and then similar to what we've been discussing before, really make sure that you have those savings. I would say just don't ever waver on that. I think that's really important, and then just continue to manage efficiently. Anytime you can reduce that vacancy, anytime you can keep a tenant in, keep them happy, that's really money in your pocket.
Yeah.
So then another opportunity, I think, is to tap into your equity. So very similar to what you mentioned in the Denver state of the market. If you've owned a property, primary rental, for just a few years, you're probably sitting on a really good amount of equity. So you could consider a couple of options: taking out a HELOC and reinvesting that, cash out refinance, reinvesting those proceeds, or trading up utilizing a 1031 exchange.
Yeah. And so it sounds like you like the cash out refis versus HELOCs.
Yes.
Why?
Because we recently did a HELOC option on a rental property, and my very basic understanding of that is that I think your credit score looks more favorably towards mortgage debt than HELOC debt.
Oh, really?
Yeah.
Okay.
So I noticed a change in that when we did that, and also I think just with the cash out refinance, there's a better opportunity to have a 30-year fix, as opposed to HELOCs are typically adjustable and they're for a shorter term.
That's my biggest reason. I just like, hey, I'd rather, if you got a HELOC, you want to do a flip or find a BRRRR or do a short-term return. I think HELOCs make sense, but what I do, hey, cool, pull out the money, buy another rental property as a down payment. Mm-hmm. I don't like the interest rate risk there.
Yeah.
So I'm curious. So you're getting your refis at 3.75 for 30-year fixed, and you said you got a couple HELOCs. What are your current HELOC rates at?
I haven't looked recently.
And are these on your primary or investments?
So we have one on our primary. I want to say that it was prime +1, I think.
So I have no idea what prime is right now.
Yeah, I haven't looked because we haven't tapped into it, thankfully.
Okay.
So I haven't really looked at it, but probably like 4.5%, I'm guessing, and then same for the other one.
Okay.
Yeah.
So it sounds like you're, the current HELOC rate's probably higher than 30-year fixed.
Yep, it's higher rate, higher risk.
Nuts.
Yeah. So long-term debt is probably what I would advocate for in this situation, especially. Now,
something you had mentioned to me, I think it was the other day when we were prepping for this, was that you are targeting rental properties that are $600 a month in rent or less.
Mm-hmm.
Why?
Because the way I think of things is kind of backing into it. So the median income in Colorado Springs is $60,000 for a household.
Okay.
So I operate off of the 3 times rent rule when I'm screening tenants. So if we take $60,000, divide it by 12, divide that by 3, we get about $1,600 as an appropriate rent rate. So if we're looking at it that way, I would presume that you would capture the majority of the market share.
Interesting.
So
I've never thought about that. That's really interesting.
Yeah, the highest rent rate that we have is $1,425.
Okay.
So we like to go a little bit below to capture even more tenant population.
Is that to capture more tenant population, or maybe more people that'll be more like a renter for life, or all the reasons? All the reasons.
I mean, yeah, if you have really increased competition, you're going to get the most qualified tenant for that property. Mm-hmm.
What about some other things to keep in mind?
Sure. So I think what I've noticed over the past couple of years for Colorado Springs is that the rent rate is not increasing as fast as the home value appreciation rate. So just to give everyone some context for that, rent prices increased by 4% from 2019 to 2020, which is compared to 3% national average, so it's still better than national average. And then home values increased by 7% from that same time period compared to a 4% national average. So if we kind of take that and apply it towards what we're seeing in terms of investment properties, a house that was bought for $200,000 in 2019 would be bought for $214,000 in 2020, assuming a 7% price appreciation. So that same house is...
Wait, back up. Say that again.
So if we were to buy a house in 2019,
okay,
just say bread and butter, 2-bed, 1-bath in a certain neighborhood, $200,000, just based on pure price appreciation, that same house would be bought for about $214,000.
Oh, the next year.
The next year.
Okay, I got you. Okay.
And then the same house's rent is only increasing by 4% per year. So if we were renting that house for, say, $1,200 last year, we're renting it for about $1,250 today. So just kind of going into it, I use the gross rent multiplier as kind of a way to...
Is that your go-to metric?
Actually, no. I think
Okay.
I think that it presented this data in the best form, though.
What's your go-to metric? Cash on cash?
Cash on cash.
Okay.
Yeah. So basically what I showed, for those of you not looking at the YouTube video, is a chart of 5 years and then rent rate, value of the property, and then the gross annual income. And then we took the gross rent multiplier. So basically what that is showing is kind of a payback period using gross rents compared to the purchase price. So in the year 2019, using those example values, the $1,200 rent rate and the value of a property for $200,000, we have a gross rent multiplier of 13.8. Whereas if we jump to 2023, that year, we have a rent rate of about $1,400, where the value of that property, that same property that we're talking about, is about $262K.
Yeah.
So 15-year payback period, or 15.5-year payback period. So I think it's just kind of important to note that even though I still think that it's a good place to invest, the longer you wait, the longer you're losing out to that appreciation that you're seeing.
So, as everyone knows, I'm a cap rate person here. So I agree with you. I think it's just the trends. And I mean, that's the trends in Denver. That's the trends in Springs. I think it's the trends in a lot of the country as well, because, the articles I read, just overall, we have a very nationwide housing shortage supply. So I think that's pretty normal. So I just took, for your 2019 year, I took your $14,400 gross annual income, multiplied by 0.67 to take out the 33% operating expense, divide by $200,000 in property value. It's a 4.8 cap rate. And then looking at year 2023, we're going to take $16,845 times 0.67. Divide that by your estimated price of $262, and that drops it down to a 4.3 cap rate. So basically, I mean, this just different way to look at it. I'm a cap rate person. I really don't know GRMs. So, based on that very simplistic modeling and just using the straight line assumptions, we're projecting a 0.5 point cap rate compression over the next 5 years, which sounds absolutely realistic to me.
Mm-hmm.
I wouldn't be surprised if cap rates compressed more. I don't know Springs, but I think in Denver we'll see it more, and probably the Springs as well.
Yeah.
I mean, when interest rates are so low, that just fuels more and more buying, which compresses the cap rates.
Yep.
Cool. If you guys want to see this chart, it's got just looks like a Excel screenshot from just 2019 to 2023. Great data to kind of capture what Jenny is saying. And if you want to see all the bullet points and the data we talked about, go to the blog post. It'll all be out there so you can see it. And always, of course, email me or email Jenny if you got questions or want more details on any market. So to kind of wrap this up, how can we help? So what I've been telling the people lately, there's three main differences about us compared to most agents out there. One is that we are investor-friendly realtors. I used to say only in Denver. Now I get to say in the spring is now with you, Jenny, so that's cool. And the vast majority of our transactions are our investment properties and really the rental property type product. And we do really work as a team. Is a second reason is a lot of agents are very impressive one-person shows. However, we are very team-centric where, for myself, I'm really good at 3 or 4 things. Jenny's very good at a handful of things as well. Then we have team members that are really good at other sections as well. So based on the needs, the part of the transaction process, you kind of get, 3 people working with you, which just makes for a smoother transaction that we've seen, and also it plays everyone's strengths, which just means we get more stuff done. Lastly, this is a really cool thing we'll talk a lot more about in future detail. I've mentioned it quite a few times, and now it's coming to fruition, is really putting in a longer-term financial planning component to real estate, so some type of like a real estate investment financial planner or some word we'll come up with. But really, hey, great, I'm buying properties, Jenny's buying properties, most people we talk to are buying properties so they can have X amount of cash flow in 10, 20 years down the road. And we have been spending the last couple of weeks with a new team member rouse. We are going through building out a very big master spreadsheet to actually put together a very like a portfolio tracker and help see where you are on track to your goal and help identify opportunities for, hey, your property is mismanaged, you need to do a better job. Or, hey, you're selling a bunch of equity, let's look at cash out refi or sell and trade up. So we're putting all this stuff in place. If you guys have questions about the market, want to sit down and talk about your investing strategy, want to sit down and review your personal portfolio, reach out to us, go to the website, fill in the form there, or go to the website and email me or Jenny. We're always happy to chat. Jenny, this was awesome, so thank you.
Thank you. I really enjoyed it.
All right, guys, well, stay tuned. We will be doing further podcasts after this. I don't know what order, but a fourplex or a multi-unit in the Springs, a house hack in the Springs, a single-family rental in the Springs, and then a Burr case that he did 3 or 4 years ago, right?
3 years ago, yep.
Awesome. All right, we'll see you guys next podcast.